본 방송에서 제공하는 투자 정보는 투자 판단에 대한 조언입니다. 방송에서 제공하는 주식의 가치, 가격 상승 및 가격 하락에 대해서는 방송사에서 보장하지 않습니다. 안녕하세요. 2022 대선 특집 월가 트레이더 버니의 진짜 미국 주식 진행의 도지은입니다. 대선 특집으로 여러분들을 찾아뵙게 됐는데요. 이 국내에만 있는 대선 관련된 이슈들과 그리고 더불어서 미국 증권의 이슈까지 여러분들 함께 챙겨볼 수 있도록 저희가 알찬 내용으로 구성을 해봤으니까 끝까지 함께해 주시면 감사하겠습니다. 또 본 방송에서 제공해 드릴 정보는 투자 판단에 대한 조언일 뿐 해당 주식의 가치나 수익률을 보장하고 있지 않다는 점까지 알려드리면서요. 그럼 저희가 준비한 내용 지금 바로 만나보시죠.
This is what we saw 2 weeks ago, okay? And what we saw right here is we saw a decline in the new highs and new lows in the end of 2018. And then we had the COVID, and now we were down here. So we can see that we were not at that peak level of COVID, but we were back to the level that we were at the end of 2018. Now, if we flip forward to the next chart, we can now see this is just blown up. This was the end of this was the beginning of COVID right here, and right here we're down to that same level in the new highs, new lows that we were in March of 2020. So much lower than where we were 2 weeks ago. So now what we have is a condition where we've seen the equivalent amount of selling that we had in 2020, in March of 2020. Okay, let's flip to the next chart. When I take that new highs, new lows, and I look at where we've been over the course of the last 20 years, now we can see not only are we deeper than where we were in March of 2020, but we've taken out the 2008-09 lows, and we've gone significantly below where we've been there. So we've absorbed a tremendous amount of selling in the market to date. Okay, let's go to the next chart. Now, if we take a look at, so if we think about the selling that we've had, okay, how can we see how that's been reflected in sentiment? So if we look at a couple of things, if we look at the option put call ratio, where the number of put buyers is bigger than the number of call buyers, we can say that that's a sign that people are worried about the market, they're trying to hedge up. If the number of call buyers is greater than the number of put buyers, we can think that people really want to continue to be able to try and capture upside on this. So we'll take a look at that, and then we'll also take a look at investor sentiment. And investor sentiment, we can say, when we do this survey, there's a survey that's done every week in the United States. How bearish are you? How bullish are you? So if we just take the percentage of the survey, the respondents, and say, how bearish are you? Let's look at what we see. These conditions right here, okay, these red vertical lines are when the put-call ratio exceeds a certain level, more put buying than call buying, and at the same time, we almost are at 50% of the survey respondents are bearish. And that's, well, you can see that if we go back the last 5 years, this is about how deep we get. This was in March of 2020 at the beginning of COVID. This was at the end of 2018 when we were, just like right now, concerned that we were going to see a significant number of interest rate increases, which never really happened. And now we're back up to this level again. And in all these conditions, this one, the decline was very, very shallow. In all these conditions, the market had turned up. So if we take that sentiment reading, the percent of respondents that are bullish versus the percent of respondents that are bearish. And we say, okay, two things. I want to see less than 22% of the people in the respondent survey say I'm bullish, and I want to see greater than a 20% differential between people that are bullish or bearish. Some people can say they're neutral. So, for example, if I have 50% of the people say that I'm bearish and 20% of the people say that I'm bullish, that differential is like a negative 30%. So 30% of the people have a more bearish opinion of the market than a bullish opinion of the market. These vertical spaces right here going back to 1987, the beginning of the stock market decline that we had in 1987, all the way through here. These are all conditions where we met that condition. 22% of the people or less are bullish, and are greater than 20% of the people, there's 20% more people that are bearish than bullish. So all of these conditions here, and you can see that outside of this event right here, all of these numbers a year later, we've been substantially higher. So we've just recognized that condition last Tuesday. That reading comes out every Tuesday. Can we go to the next chart? Now, since we are worried about interest rate hikes, what I did was I went back and looked at from the time we make a hike to the time we stop raising rates. I looked at the implied Fed funds rate, because the implied Fed funds rate should match or correspond with rate hikes. So we anticipate a rate hike in March, and then we're going to go on from there, and how many we get, we don't know. But what I found was, since 1989, I took all the conditions where we've had rate hikes and said, what did the market do? We know when we have rate declines, when the Fed's actively easing in the market, that the stock market does better. Does the stock market do worse when we have rate hikes? And what we found is no, it doesn't. It often does better. Not necessarily all the time. So what we have is, I've identified 4 conditions before this time where the Fed funds rate went up. The effective Fed funds rate went up. In 1994, in 1999 to 2001, in 2004 to 2007, and then in 2018, when we were concerned about that market, to mid-July of 2019. And what we can see is the S&P and the NASDAQ, they were higher here, lower here, higher here, and higher there. Now this one is not as low as the actual decline in the market, but there were other things going on during that time that we had during this period where it wasn't just the Fed funds rate that was moving the market. We also had during this period 9/11, and we also had during this period the dot-com bubble. So in essence, what we can think about is declines in the stock market don't always go along with interest rate increases. And we don't even know what we're doing right now is we're probably in the period of maximum concern about interest rate increases currently. What I think we need to think about is what the stock market is going to be thinking about 6 to 9 months out. How are earnings going to perform? And what kind of liquidity is going to be taken out of the market relative to what the market really needs? Are we going to go through periods where there's much less liquidity in the market, and will the Fed truly follow through on its initial discussions and comments that they're going to have a significant number of interest rate increases? I think Just like always, the Fed doesn't know much more than the market already knows now. The market's going to be thinking about what's out 6 to 9 months. And if earnings can continue to grow this year, the stock market could have a significant bounce from here. To update the stocks that we've talked about over the last 6 months, what we want to do is we want to continue to monitor the health of those stocks. Those stocks have been significant growth stocks, whether we talk about Google, whether we talk about Apple, whether we talk about Bill.com, whether we talk about Zscaler. All the stocks that we've talked about are all growth stocks. Many of the growth stocks, just like we've talked about in this period, have declined substantially because of the expectations that higher interest rates may have on future growth. But what that can do is that can give you buy opportunities for stocks that are very, very cheap. And we'll talk about one of those in this sequence when we go through all the stocks. I always want to do this because to me this is like a report card for the market, because we can look at indexes all the time and we can say the NASDAQ went from here to here, but it's the individual stocks that we own and the stocks that we want to own that are outperforming the NASDAQ. That's the thing that we really want to look at, because that's where the great returns are. The stock market can give you 9% a year, but when you're buying stocks that are outperforming the NASDAQ, you're getting 30, 40, 50, 100, 200% in a year. Those are the stocks we want to take a look at. When we looked at Bill.com, that went from 115, I think to 175, all the way up to 400, and then back again. It retraced a significant amount. We want to be able to capture returns on stocks that are going to grow, that the market's going to realize that the revenues are going to grow much faster than they thought about, because they're in a really great situation and they're in a really great sector of the economy that's a growth sector. That's the kind of thing that we want to think about. So let's just quickly go through the stocks that we have right here that we've looked at so far over the last 6 months. In Bill.com, we can see when we looked at it here and it rallied, it outperformed the market. Now, since the end of November, it has substantially underperformed the market. But what we want to do is own stocks that are high, that are moving up, not moving down. Let's try the next one. Microsoft. Microsoft has continued to outperform the market. Only for the brief portion of the first 2 weeks of this month has Microsoft underperformed. And then it had an earnings number that was good and the market's back up. So it's still in a positive environment. Let's flip to next. Amazon. Amazon has underperformed the market all the way through 2021. Still a great stock, still has so much to do, Amazon Web Services, but we want to identify conditions where we can outperform that stock. That stock will outperform the NASDAQ, and it has not done that yet. Next stock. Upstart, another great outperformer, and then since the early to mid part of November has underperformed. One of the stocks that we want to keep an eye on still. Next one. DocuSign. Great outperformer earlier on in 2020 during the COVID epidemic, and since September has underperformed the market. And we want to keep an eye on that. We don't want to be in these stocks when they're underperforming the market. We want to move the portfolio around, because if you're going to be invested in stocks in the long run, you're either going to have to accept the volatility or identify conditions where you're in a high growth stock and that stock starts to underperform. If it outperforms, it can stay outperforming for an extended period of time. It's kind of part of the reason you have to do homework all the time to be able to monitor the stocks in my portfolio. Next one. Netflix. Okay, this is classic. Okay, so we had a decline right here. We talked about Netflix doing better at $515, and Netflix did do better. It got up to $700. When it rolled down earlier in end of November, early December, it continued to collapse. This was about $600. So you were able to capture something, not that much, but you would have avoided the problem. Now let's go on one more to Netflix, the next chart. Interesting here, Bill Ackerman runs a hedge fund. It's a $13 billion hedge fund. It's called Pershing Square. Bill Ackerman is one of the best performing hedge funds in the country, year in, year out, decade in, decade out. They've done a tremendous job. And what Ackerman did, he just bought Netflix this week, and he purchased 3.5 million shares. 3.5 million shares at, let's call it $350, is about $1.2 billion worth of stock that he has now in his portfolio of a hedge fund that has a $13 billion total assets under management. When we look at Netflix, and we talked about this right here, this is the chart we just looked at, okay, where we compare Netflix to the NASDAQ composite. And we found that period where we outperformed, we got up to $700 almost, then we started to underperform at $600, and that stock has gone down. Down here, Ackerman has accumulated this. And if we look at it, $350 is almost halfway back on that stock. So Ackerman believes that Netflix still has great fundamentals. He loves the revenues of the stock. He believes that the revenue is going to grow significantly going forward. He loves the management of Netflix. And if you bought Netflix, you could have bought it and made a return. Let's pretend you bought it at the initial public offering and it went up to $700. You would have returned over 500 times your money on that. But you would have suffered significant price declines, just like we're seeing right now. So to be able to capture a stock and have it go up 500 times versus your original investment, or 300 times or 100 times or 50 or 25, you're going to have to accept volatility. Netflix was one of the great performers in this whole last, say, 7 years, 8 years, and not all stocks are like that. But there will be some stocks, and we will trip over some of these stocks. Hopefully that'll be the Netflix, because we're constantly monitoring stocks that outperform the NASDAQ, and they're in growth sectors where we anticipate revenues to grow faster than everybody else thinks. Let's go to the next one. So, just like I said, in summary, Netflix had its best rally in a year between August and November. But the stock failed to outperform around $600. The stock has retreated down to 50% level, and now we're starting to see astute investors start to accumulate stocks down there. Let's try the next chart. IDEX. So this stock, great outperformer over time, has underperformed since late September. The next stock. Chewy. Chewy basically has had a really poor year this year. Underperformed the whole time. Revenues continue to grow. Income's okay. Income's matching expectations that the analysts have. But the stock's not outperforming the NASDAQ. During this period, the stock rallied because the NASDAQ went higher, but it didn't outperform. Let's go to the next one. AMN. Stock basically has outperformed almost through the whole period of time. We had one kind of very, very difficult week, and we've chopped around, and we're back below, monitoring to see if we can get that stock above. Next one. Fiverr. Same thing. Tremendous move up, and then nothing. So we're continuing to monitor Fiverr. ANET, Arista. So we can see right here that since October, when other stocks have declined, this stock has continued to go higher. Now, we know why we like this stock, because the founder owns $5 billion worth of this stock himself. That's a great thing. The revenues are great. The industry that they're in is a solid industry. It's really growing because they're going to provide the infrastructure for the cloud. So it's a stock that we like, and we want to stay with that stock as long as it outperforms the NASDAQ. Next one. The trade desk. So we had a great outperformance here, and then since then, nothing. We had a big shot up, but it didn't hold, and we're back down again. Next one. Tesla continues to do better. Continues to do better, and has done better since August, September. And don't forget, September, October is when some of these stocks have started to fall down, and not Tesla. By the way, at the top of the market, Elon Musk said he had to sell these shares to be able to pay his tax bill. He sold Tesla at the highs of the market, the highs of the move for the stock. Really astute. Next one. CrowdStrike, same thing. Had done better pretty much this whole time up until about November. Since then has gone down and suffered just like with all the other technology stocks. Next one. Zscaler. Zscaler had done great basically through most of this time. Only lately as it started to break down. Great company though. We want to continue to monitor that one. Next one. Shopify. A classic, okay? Shopify is such a great company, but look at what they've done, and look at what we would have avoided if we just didn't want to stay in the stock as it failed to outperform the NASDAQ. We can see that the moving average lines are flat; they're not really doing anything, and the stock just has continued to underperform. But Shopify is truly one of the great stocks. You could have bought Shopify at the equivalent of, say, $10, and it's at $870 now. Even with all this, it had gotten up to $1,500. Next one. Unity Software. Another one where from August to December, late November, early December, it had done great and it's now underperforming. It's another stock we want to watch. We want to keep thinking about that. Next one. Facebook. So Facebook to me hasn't really done that much over the course of the last, say, 6 years. And I only have the last year and a half, 2 years on this right now. But we can see that Facebook is starting to base, and I want to see if it starts to go back above and be an outperformer. And it's hard to anticipate where the metaverse is going to take us or not take us. It's hard to anticipate is how much of a contribution that Facebook is going to make to that and how much revenues it's going to be able to attract into that. But I think we still need to watch it. Next one. Starbucks. Just not a big fan. And we can see that, and I talked about it before, I thought the president of the company did not own enough shares. He wasn't committed enough to be on the same level of commitment as shareholders were. I think he tried to capture, they tried to pay him too much, and there's a lawsuit that they think that he's been overpaid. I don't think that lawsuit will hold up, but those are all warning flags. And that stock really, from here to here, has not really been a good market performer. It's been an underperformer. Next one. Roblox. A big pop early. Same thing, like this stock could be a big significant factor in the metaverse. Maybe, maybe not. We'll have to wait and see. But not now. It has hit the declines, the same thing as other stocks that suffered. And we could see that when we looked at the advanced decline line of the NASDAQ stocks and the new highs, new lows. We could see the erosion of NASDAQ stocks early on in November and December of this year, late November, early December. Next one. Snowflake, another one that had a great year going so far, and now it's just underperformed. We want to keep an eye on that. We still love that stock. We anticipate revenues of that stock should grow faster than the market thinks, the analysts expect. Next one. Akami. economy's doing great right now. It's a stock that is now starting to outperform, and it's been an outperformer in January. They can still be down, but we're not down as much as the market. And when the market rallies, we're in much better shape being in an outperformer than an underperformer. Next one. Google. We can see how good Google is, and since late November, it hasn't really done much relative to the market. Let's call it a market performer right here to a slight market underperformer, but I still want to keep an eye on Google. Next one. Apple. It's going the other way than all those other tech stocks. It's done great. It continues to do great. Although Apple is down, it's down much less than the market, much less than the NASDAQ composite. Lucid, another one. From the time they released the information on their first battery car, electric vehicle, the stock has continued to stay above the NASDAQ. It's continued to outperform against the NASDAQ. The next one, Disney. Disney has underperformed the market since the end of the first quarter all year. We continue to watch it, but I think and we've talked about issues with Disney. I just think that stock, I don't know if earnings are going to grow faster than everybody thinks, and revenue is going to grow faster than people anticipate. It's gotten to a really big company, and the biggest part of the revenues that they generate are in the media sector. And I just don't know if that revenues from the media can grow so significantly to make this a great outperformer stock. Next one. Hasbro. Hasbro's done better. Don't forget, at the end of October, the beginning of November, Hasbro's chairman passed away through I think he had cancer, and they have a new chairman now, and the stock is starting to do great relative to the rest of the market. The next one. Boeing Aircraft. Boeing Aircraft is done better, but look, don't forget, we're at the bottom end of this chart going back here, and I think this outperformance is more on a defensive nature than an aggressive nature. So I think Boeing Aircraft only outperforms the market when the market goes down. It doesn't outperform the market when the market rallies. And those are the stocks that we really want to keep an eye on. Next one. Nvidia. Nvidia has only started to underperform the market lately, but it has had a tremendous run from the beginning of this chart down in April, May of 2020, all the way through December, and now it's starting to roll over. But we really like that stock. Finally, what we've done is we've got 29 stocks that we monitor. And when we're above 50%, the health of the market's great. When we're below 50%, we have to be cognizant that the health of the market's a little bit exposed. And that's why we look at new highs, new lows. We look at advanced decline lines of the NASDAQ composite. But what we've seen, I read this and we looked at it at the middle of January, and we were down here at basically 24%, and now 31% of the stocks are now starting to outperform. We want this number to keep working higher. And some of these stocks are outperforming because as the market's going down, those stocks are not going down as much, or they're starting to rally from a base down here. Well, we know that when the market goes down, volatility goes higher. And so we are cognizant of that fact. What we want to identify is, where did those periods of high volatility, where did those periods tell us that this could be an attractive place to add to equity purchases? So what I've done is, if we take a look at the VIX, okay, the VIX is a measure and it charts every day, and you could actually trade the VIX. The VIX is a measure of the stock market volatility 30 days out. Okay, so right now we were about 32% as of Wednesday of this past week. We were about 32% volatility, and that is coming from down around 15% in the middle of December, even when stocks were starting to go down. So now what we're seeing is we're seeing big ranges intraday during the day, and also big up and down closes, mostly down, obviously. And that's been reflected in the fact that the market's very volatile, and the VIX is indicating that. So what we know, if we do studies and we go back and we look over time, let's take a look at a 5-day average of volatility right now, and that number is very close to 30% as of Wednesday. As of now, it's even higher than that. So where is it that we know that there's a good deal of volatility and that maybe that's a place where the market can start to really move up from? So what we do is, if we look over a 14-day period, okay, once volatility exceeds 30%, what happens to the market 1 year later? That's the question we want to ask the market. And what we really found is that 33% is a great number, that once we get to a 33% volatility averaged over 14 days, and by the end of next week, that'll be about 14 days, that's been a indicator or coincidental occurrence with stock market positive performance out 200 and out 500 days. So let's look at the next chart. And what we can see, we're going to look at this on a 200-day basis first. And what we've done is we've taken the VIX levels, okay, and broken them down, okay, by bands. So 20 to 25, 25 to 30, 30 to 35, okay? And then we've gone across and identified not only the market sectors, but the overall S&P 500 return. Now, my contention is that greater than 30%, okay, where is the market 200 trading days out? And what we can see is the stock market does better. Obviously, the higher the amount of volatility, the lower the market's going to be, and the higher the returns 200 days out. But we can see right here in the technology sector, which has been hit the most, is that once we get to that 30% or more, that's when we can look out 200 days and find good returns. So average is 16% out 200 days. The same thing with consumer discretionary, the same thing with financials, and the same thing basically across the board. Energy, not so much. And healthcare is good. So what we can see is if we can average, if the market does average over 30% over a 14-day period, returns out 200 days are positive. Let's go to the next chart. Look at the same thing out 500 days, okay? And this is over the last 23 years. So we can now see these returns are even more significant 500 days out. Same condition that happened, instead of 200 days out, 500 days out. And now we can see is instead of 15, 16%, we're up to 28 to 40. We're up solid numbers across the board here. So if we can average those kinds of volatilities, what we've seen in the past is that the market 200 and 500 days out has a good rally potential, and we've experienced great stock market returns from that period. So it could average more than 30% for more than 14 days out. But once we hit 30% for 14 days, these are the numbers that have been reflected. Let's look at the next table. So just like we talked about, 14-day average, averaging more than 30%, okay, that would suggest that the market currently is attractively valued. And what we've seen so far at the end of this week is that there are people coming in to accumulate stock, just like we saw Bill Ackerman and Pershing Square buy $1.2 billion worth of Netflix stocks. Other people are starting to buy now. So at these stages in the game, we're now at levels that are really attractive. Remember, we looked at the advanced decline line and how significantly down that was, down much greater than we saw in 2008. We also looked at new highs, new lows, and new highs, new lows were matching where we were in March of 2020. Now, I'm not saying that this is the bottom of the market, but the market goes from down to up to down to up. And if you wanted to say where we think the market's going to be out 200, 500 days, out 1 year, you have to say that given where we are now, that we would be higher. But it's all still, just like the stock market does, it doesn't move in the easy direction. Everything's a little bit of a challenge. But conditions warrant not selling here as opposed to conditions warrant buying here. Let's look at the next clip. Now, we've talked about before, the stocks that are getting hurt now are technology stocks. And we've talked about the reasons why. The anticipation that higher interest rates down the road are going to have more of a compounding effect because technology stocks earnings grow faster than other stocks. And we love stocks that find revenues, excess growth, and earnings excess growth. So when we look at where that, and we know that the growth stocks have outperformed value stocks over the last 20 years by a substantial amount, okay? But where is that premium of growth stocks? So if we take the S&P growth index and divide it by the S&P 500 index itself, okay, what we see right here is a chart that basically is on an upslope until lately. And then if we take the same thing and we take the value stock index and divide it by the S&P 500, and we can see that that stock didn't quite do as well, but now lately it's doing better. So what we see is that the premium that we had from the beginning of COVID all the way to here, okay, to the end of sometime in the fourth quarter of last year, has gone away. So our growth stocks are priced at the same levels that we were in 2020, early 2020. So when you're buying prices and you're buying returns from growth stocks, if you buy the right growth stocks, you're not paying a premium relative to where you were at the bottom of the market in March of 2020. Well, there's so many factors that affect the market, okay? And then we can take a look at the market and we can say it's cyclic, okay? Or it has cyclicality to it. In other words, it tends to do similar things over time in certain conditions. You know, when the Fed eases, the market tends to outperform. When the Fed tightens, the market doesn't outperform as much as when the Fed eases, although we've shown that the market does outperform sometimes, actually more than often. But one of the things we're in this year, this is 2022, is a midterm election year, an off-cycle election year. So our presidential elections are every 4 years. So in the middle, every 2 years after an election, and then every 4 years after that, we have midterm elections. So what we found, though, is when we go back to 1950, post-World War II, what do the returns look like in a midterm election year? So let's take a look. Now, what we've done here is I've identified the year, okay? I've identified the date of the low, okay? The pullback within that year, so the amount of price decline we saw in that midterm year, in essence 2022, the return 1 year after the low, and then I've also added our governing parties and who's leading in what. So is it a Democrat or a Republican? Is in the President's office, in the Senate, in the House of Representatives. And finally, I've said, are there exogenous factors that affect the market, global issues that are driving that year? So the Korean War, the Bay of Pigs, where the Soviet Union installed missiles into Cuba aimed at the United States, the Vietnam War, 9/11, all sorts of that. And what we want to see is, let's go through each one of these years really quickly and identify what's happened and where we go out after that. Because we're going to work on the premise that there are opportunities to buy the market in a midterm election year, and we're going to prove out whether that's true or false. So 1950, we were down 14%, we rallied 31%. We have what we have this year: a Democratic president, a Democratic House, and a Democratic Senate. Okay? 1954, and that, by the way, was in the Korean War. 1954, we had a great rebound year. It was all Republicans at that time. 1958, we were up. Okay? 1962, we were up. We had a Democratic president, John Kennedy. We had a Democratic House and a Democratic Senate. What we had in 1962, we had basically, let's call it a spy plane, a U-2 plane that got taken down, U.S. plane taken down in the Soviet Union. Is a big deal. They held the pilot captive for a period of time. And on top of that, the Soviet Union brought in the missiles into Cuba that year. And so there was a lot of basically internal issues between the Soviet Union and the United States in terms of conflict. 1966 was the height of the Vietnam War. It was all Democratic, and we were 33% up that year, the following year off the low. So let's go to the next sequence. 1970. So these are all in about 15 years. So 1970, we pulled back. We were split. We still had more of the Vietnam War. You can see these rallies are fairly significant. 1978 was not. But 1978, what we had in 1978 was we had the stagflation, where we had very high unemployment and very high inflation at the same time. And so we really saw no growth. Jimmy Carter was our president. He was a one-term president. He lost to Ronald Reagan because Ronald Reagan asked people, do you think you're better off than you were when Jimmy Carter got elected than now? And it was kind of a blowout. Jimmy Carter lost, Ronald Reagan won, and they turned the presidential office basically to a Republican for the next 12 years. 1982 was the bottom of the stock market, and we had a 58% rally that year off the low, and that stock market bottomed in August of 82. 1986, we had a big rally. Let's go to the next. So you can see every year, a year out, we've had a big rally. Now what we're going to find, though, is that we had fairly significant declines. But when we go and we try and look back at what we had on this decline right here, we had the dot-com bubble, where we had inflated the value of stocks to a level significantly higher than what we've inflated the value of stocks this time. We had 9/11, and we were preparing to invade Iraq. So there was so many issues going on at that time, and I think that's one of the causes that we went down so much. But that was a great chance to make purchases down there, and we rallied fairly significantly after that. Let's go to the next clip. Okay, so 2010, we have what we had again. We were in the throes of the Afghanistan condition in basically 2011, 2010, and 2014. In 2014, Russia invaded Crimea. But we still have had positive returns out 1 year and not significant negative drawdowns during this period, similar to what we have right about now. Currently, we're down 11.4%. So if we look, the average decline during a midterm election year is about 16%, a little over 16%. And the median, half of them above, half of them below, is 15%. So we are right now probably, the stock market's down, the S&P 500 is down 11.5. We're down a little bit less than the average. We may go lower. I'm not necessarily saying this is the bottom or not the bottom, but the returns out 1 year are fairly significant from the date of the low. We still don't know what the date of the low is. Right as of today, the date of the low is this week, but we don't know for sure going forward from that. But I think that the midterm election analysis has shown that since 1950, and we've had basically 70 years, every 4 years, and we've been higher, substantially higher, 1 year after the low during that period. Now, what we can also say is, since we look at a midterm election year, the low has probably been made in the first half of the year. Not always, but the low has probably been made in the first half of the year. And then the move is 1 year out from the date of that low.
네, 오늘 저희가 준비한 소식은 여기까지입니다. 또 본 방송에서 제공해 드린 정보는 투자 판단에 대한 조언일 뿐 해당 주식의 가치나 수익률을 보장하고 있지 않다는 점 말씀드리고요. 또 서울경제TV, 서울경제신문은 당사의 브랜드란 점까지 알려드리도록 하겠습니다. 그럼 저는 여기서 인사드리겠습니다. 시청해주신 여러분 고맙습니다.
본 방송에서 제공하는 투자 정보는 투자 판단에 대한 조언입니다. 방송에서 제공하는 주식의 가치, 가격 상승 및 가격 하락에 대해서는 방송사에서 보장하지 않습니다.